Let's start by getting your reaction to those comments from the WHO Director General. He's called for calm across asset markets. Do you think this is going to have an impact, or is it going to get worse before it gets any better?
Well, it's very good that he's called for calm, but it obviously is going to make no difference at all. Obviously, what we want from the Director General of the World Health Organization is rationality, someone who says, look at the facts, let's respond to that. But that's not how markets work, is it? Markets respond very quickly. Markets weren't really paying attention to it until last week, and now they are. My expectation is that we're going to be watching the data very closely. Sure, Federal Reserve, if they respond, we're seeing fiscal responses out of Italy. That's all positive. That should calm things down for the time. But we're not out of the woods yet.
Chris, it's interesting, isn't it, when we take a step back and think about this and how it's going to impact this region. We're talking about lower oil prices. We're talking about a lot of fear ahead of this OPEC Plus meeting. And if you just take a quick look at the head of the cover of this Arabian Business magazine, I mean, when we think about this part of the world in terms of the rumor mill and the fear-mongering, how worried should we be about this economy specifically? The UAE, we're heading into Expo 2020. We're talking about an international transportation hub that's had to, essentially tell people to stay home, don't come to work, because they're not filling the flights.
Yeah, well, it's precisely not what this region needs at the moment. It's been suffering hugely over the last few years because of lower oil prices. Now, remember, those oil prices filter through into higher deficits, fiscal deficits, and we've had a lot of fiscal control, and that's really slowed domestic growth rapidly. Obviously, if you see the oil price back down at $50 a barrel for an extended period of time, that's going to force governments to cut spending and to continue to roll out fiscal control. That's obviously very bad for the economy anyway. Plus, you have the sentiment, you have an international hub here. It's a big problem.
Yeah, absolutely. So it's really uncertain as to what happens next. Are you able to quantify the economic impact that this is going to have in Q1 or even Q2? Can you put a figure on it?
Yeah, well, let's try and sort of work backwards, if you like. I mean, China is now looking at 4.5% growth this year, let's say, as opposed to 6%. So if it's 20% of the global economy, that would be global economy growing at 2.75%, not 3%. But then think about the impact on the rest of the world, not just China, and you're down at 2.5%. Think about the worst case scenario. Think about growth falling 25% globally. You're talking more like 2% growth across the world. That's very, very significant.
Chris, Matt also has a question for you.
Yeah, hi there, Chris. Thanks very much for joining us. How aggressive do you think the global central banks will be when it comes to combating the impact of the virus on global economies?
Well, I think having really been sort of sanguine about it up to now, I think they will get aggressive, and I think we will see 50 basis points cut out of the Fed, certainly in the first half of the year. But the problem is you have to worry about what effect that can actually have. After all, if it's a supply chain problem, then what are interest rate cuts going to really achieve? If it's a demand problem, if people aren't going to restaurants or they aren't going on holiday, again, what are interest rate cuts going to achieve? The real impact is if there is such a slowdown that we see a tightening of credit markets and bankruptcies across the world. And that's obviously where we know central banks are going to react very aggressively indeed. But in terms of short-term economic gain out of these rate cuts, don't expect too much.
What's that going to do to markets, and have you changed your investment strategy in the wake of the sell-down that we've been seeing over the last week or so?
Yes, well, obviously, we've seen rate cuts coming every time markets have fallen aggressively since the financial crisis. And the first response from investors will be to buy on this kind of news and see if there's a short-term gain to be made. Of course, you have to wonder if coronavirus is really going to lead to a permanent diminution of value of 10% of global stock markets. So in that sense, you can understand people buying on the news of rate cuts. But again, we just don't know the long-term impact. Uncertainty is always a killer of market sentiment.
Chris, final question. I mean, when you think about this within the context of the U.S. presidential election, we've just seen Joe Biden sweep the South Carolina primaries. This was something that was a surprise, frankly, for a lot of folks who were considering this would be a shoe-in for Bernie Sanders across the board. When you think about this with regards to the Trump presidency, we've been talking about this quite a bit, on November 4th, if the economy is not in the same place he was hoping for, he might not get reelected. I mean, where do you see this playing out? Because this has implications for the Fed.
Well, it does. I mean, I just dread to think what he might say or who he might blame for coronavirus, to be perfectly honest with you. I mean, obviously, he will put pressure on the Fed to act, and that leads to more politicization of monetary policy, which is something that markets are wary of. But expect him to enact fiscal measures, monetary measures, whatever it takes to help.
To help the economy.
Absolutely.